My name is Curtis Montgomery. I'm an investor based in Singapore since 1997, and my company specializes in investment in two basic asset classes. Number one is the stock market here in Singapore, the Asian equity markets, and in the last 6 years or so we've diversified more of our funds into investment grade wines, and that's what I'd like to talk to you about today, is the investment in wine. Wine is an interesting asset class. It's been around for hundreds of years, and some of the chateaus have developed wonderful brand names globally. The world is awash in wine, and not much of it is investment grade, so you have to be careful what you invest in when you decide to go into wine as an asset class. It does have many advantages, but it requires a bit of study and a bit of care. You can't go into the grocery store and buy your investment grade wines. You're going to have to select some of the outstanding wines in the world, which is maybe just 1 to 3% of the wine produced that I would call investment grade. As an investor, you'll eventually migrate to France. The chateaus of France have the wonderful reputation, centuries-old brand names. The wines are built to last. They can age for decades, and they tend to have nice global markets for trading cases of wine around the world. Within France, you have different regions: Burgundy, Champagne, Bordeaux. The most classic investment would be the Bordeaux wines. Not to say you can't make a good return with nice champagnes, or good Burgundies, or even Rhone wines, but it's Bordeaux where the investor will want to put most of his focus for investment grade wine. Within Bordeaux, which has hundreds of chateaux, you can really make a career investing in wine with just focusing on the 5 first growth chateaux of Bordeaux, which is Chateau Lafite Rothschild, Mouton Rothschild, Latour, Margaux, and Haut-Brion. This is a bottle of Chateau Haut-Brion. But when you invest in wine, you don't go out and buy individual bottles. The trading unit in wine is a case of wine. And to show your eventual buyer that you have a quality wine, you want to have it in the original wooden case, where you'll see designated OWC. So always buy your wine in a case of 12 bottles. Some of the more rare wines will be packaged maybe in 3 or 6 to a case, but typical unit is 12 bottles of wine in its original wooden case, packaged at the chateau. When you buy your wines, the best case is to buy what's called ex-chateau, where the wine is shipped to your warehouse, which specializes in wine storage, temperature and humidity control, directly from the chateau's cellars. Now this is done. You can't call up Chateau Lafite and say, "I'd like to buy some wine." They will not deal directly with individuals or even large investors. They deal through a network of what's called négociants. Wine Central, as like Wall Street of stocks, the main hub for wine is in London. And London has many négociants that deal directly with these first growth chateaux. They buy the wines even before they're bottled, what's called an en primeur, a futures market, and then they distribute to retailers, wholesalers, and investors around the world. Each year, when the grapes are harvested at the chateau, they are crushed and fermented into wine and then put into oak barrels to age for about 18 months, and then put into bottles about 2 years after the harvest. But during that 2-year time frame, they will actually put out a futures market through the négociants, where you can buy an allocation of say 10 cases of Chateau Margaux when it's still in that barrel being aged, and then 2 years later, when it's bottled and shipped, you'll be guaranteed to receive nice pristine condition original wooden cases shipped directly from the chateau of that new wine. Now the advantages of buying en primeur or futures are many. Number one, you're getting a release price, which is hopefully going to rise, and you'll be locking in the lowest possible price for the wine. There's no guarantee of that. It's open to market forces, but historically that's the best entry point for the price. Number two, you're getting the pristine cases directly from the chateau. And number three, you're guaranteed that allocation. So if the wine becomes kind of hot, there's a speculative market, a lot of people will search for that wine and not be able to buy it after it's bottled, but you'll have locked in your allocation ahead of time. The disadvantage is that it's a cash market, so you'll be paying cash in advance, 2 years in advance, before you receive your wines. And you must pick a trustworthy négociant who's in good financial condition to assure that you're going to receive your wines. Now, supply and demand, I want to talk about a couple of forces that move wine markets and why wine is a nice alternative investment to the stock market. Stock markets are extremely volatile. It's not unusual for stock prices to move up and down 50% in a given year from its high to its low price. So that's a tremendous amount of volatility that an investor has to be willing to take. Wine is not like that. Wine It has certain market forces that keep the price more stable and tend to have a slowly appreciating price over time. Now, what causes that? Number one is global supply and demand. Another good reason to invest in these first growth chateaux of France, especially in Bordeaux, is that they are a property. They're defined by a property line. And by French law, no matter how great the demand grows over the years, that chateau cannot expand. It cannot go beyond its current walls. And in fact, these chateaus were defined back in 1855, that's when they were graded. Many of them are even a century older than that. But they cannot, by law, take grapes outside the chateau and put it into that wine, so they can't increase their production. Indeed, over the years, they've developed second label wines, so they can sort their grapes and only get the very best product into their Grand Vin. So the volume of their great wines is actually shrinking over the years, even as supply grows. And of course, that creates the market dynamic that prices must rise. As the wine market develops in China, India, South America, I think it's quite obvious that recession aside, during normal times you will see a steady increase in demand, perhaps even a great increase in demand, but there will be no increase in supply. So that's what makes French wines quite special as an investment. Secondly is that the wine disappears. A certain vintage, say 2000 Lafite, there are only so many bottles made originally. As that wine ages, it gets to be 5, 10, 15 years old, people are going to open up the bottles and enjoy them. Connoisseurs are going to enjoy the wine as it matures. And certainly when it gets to be 10 to 20 years old, it'll start rapidly disappearing from the market. So even though more people will be looking for those mature wines, the demand is high, the supply steadily diminishes towards zero. And again, you see the price rise more rapidly as the wine gets more mature. Bordeaux wines and good vintages have a very long lifespan. So as an investor, you're not under pressure to sell a product that may diminish in value. Not like a food product or a consumable product. This product will actually get better and better after 10, 20, 30, even 40 years. As it ages in the bottle, it matures, it develops nuances, complexity in the aromas and the flavors, and connoisseurs will have a higher value on the aged wine, even though the supply is diminishing. So you can store these wines away and be assured that they're going to increase in value, be an appreciating asset, not a depreciating asset in your storage. Now again, a disadvantage versus the stock market is that instead of receiving dividends every year, you're going to have to pay some storage costs and some insurance costs each year. So you do have some costs that go on over time. That's another reason to stick to the higher priced wines like the first growth chateaus. The wines are so expensive, more than $1,000 per bottle, that makes your storage costs and your insurance costs quite small as a percentage of your asset value. Now there are a couple of times when you want to think about selling the wine where you typically will see a price jump. Number one is if you bought the wine en premier in the futures market, you buy 2 years ahead of receiving the wine. As I said earlier, you'll lock in typically a good base price. Now when that wine is bottled, sent out to the retailers, shows up on shelves around the world, sometimes you'll see a bounce in the price there. So when you've had the wine for just 2 years and first received bottles, you may want to look at if it's profitable to go ahead and quickly turn around your en premier purchases. Another time is when the wine hits about 10 years old. These good Bordeaux wines will tend to get to what they call a drinkability age at about age 10. And restaurants, fine restaurants, will start putting 10-year-old Bordeaux on their list, you'll find. So the consumption rate and the demand from restaurants around the world will tend to have a bounce around 10 years of age. So that's another time to keep a close eye on your pricing in the markets, and you may want to sell at that time. When you're buying your wines, you don't want to buy retail, pay full retail price, because when you go to sell, odds are, unless you have your own retail shop, you're going to be selling wholesale. So you don't want to fall into a buy retail, sell wholesale trap where you're starting out in a big hole where the price may have to rise 20 or 30% before you could even break even. So you want to find a network where you can buy your wines at wholesale, just like your local retailer does. Then as the price rises 20%, you can wholesale it back to him. He puts his retail markup on that, but you don't have any of the carrying costs of running the retail shop. And you have a nice clean wholesale business dealing in units of original wooden cases of the wine. So these are some keys to making your investments. So again, the advantages are that wine is a very long aged product you can keep for decades. Number two, it has lower volatility compared to the stock market. Number three, it acts as an inflation hedge. During times of high inflation, wine prices tend to skyrocket. Number four, it's not tied to the other classical markets like stocks and bonds. These assets are not very well linked. So when stocks rise, wine may be steady. Wine may rise when stocks fall. They're quite decoupled asset classes, which gives you some free diversification in your portfolio. There are costs, transportation costs to get your wine to your warehouse, insurance and storage, and you don't receive any dividends. That's a downside. But overall, I have certainly found that it's been a satisfying diversification of assets to have this real asset, this tangible asset, and then couple that with stocks and bonds. And you can move your assets back and forth between these classes as they go through different cycles on their own. So I encourage you to look into wine investment as a wonderful diversification for your portfolio. Thank you.